Welcome back. This is Chapter 10, Liabilities. Okay, so at this point we should all know what liabilities are. Those are the obligations we have in our business that show up on our balance sheet. Liabilities are created when a company buys goods and services on credit, obtains short-term loans to cover gaps in cash flows, and then issues long-term debt to obtain money for expanding into new regions and markets. Current liabilities shouldn't be new to you either. They are defined as the short-term obligations that will be paid within a year. On this screen, we show the liability section of a recent balance sheet for General Mills. And as you can see, there's various types of liabilities at the end of this fiscal year. So we have our current liabilities, those things that are like accounts payable, accrued liabilities, things that will be paid off in the current year. And then we've got down here long-term debt. It's got its own category. So we like to separate the current and the long-term. So remember, liabilities are on the right side of our accounting equation. So if you remember, things that are on the right will increase on the right with a credit. So when liabilities increase, that would be when the company receives goods or services on credit or takes out a loan or issues debt. Anytime we owe someone money, we're going to credit to increase our liabilities. And then we're going to decrease or debit our liabilities when a company pays on its account and reduces its obligation. So hopefully by now also you've already had an earnings statement or a check stub from your employer in the past for one of your jobs, your current job, that shows your gross wages less any taxes. And your text doesn't go into too much detail on these type of payroll accounting, but I think it's really important, so I want to fit it into this chapter. All employers must account for payroll, and many companies actually have a staff devoted to preparing payroll, and that's all they do. And in this earnings statement, for example, you see the gross earnings, which is just the product of the rate times the hours. That's your gross wages. But of course, there's some things that need to come out, some deductions. Payroll deductions are either required by law or they're voluntarily requested by employees. Now, the law requires that employees deduct federal income tax and possibly state, county, or city income tax. And here in Kentucky, we have state income tax from each employee's gross earnings. And then the law also requires, through what we call the Federal Insurance Contributions Act of the 1935, which includes Medicare and Social Security. So anytime you see FICA on your earnings statement, it means Social Security and Medicare. In addition, there's all kinds of other deductions the employees might choose to voluntarily have taken out. So in this case, here we have the federal tax, we have the California state tax, and we have this thing called SDI. There's a disability insurance, but there could be things on there like United Way, charitable donation, or maybe a union due, anything that the employee wants to take out. You'll see that as a deduction. Now, employers don't just keep that money they deduct from their employees' paychecks. They're actually obligated to remit those deductions withheld to another organization or government agency on the employee's behalf. So the employer is going to classify all those different deductions as current liabilities because they will take them out and they will owe them to the responsible parties. So this is a summary of what the employers will withhold from the employee's pay. So coming out of the employee's pay, you'll see the federal state income tax, Social Security tax, Medicare tax, and then all those other charitable or insurance deductions. That is coming out of the employee's pay by the employer. So this is the effect of the earnings statement we just looked at. The gross earnings from the employee is the total amount that went into the salaries expense. So this is what the company is going to book. They're going to show that there was a salaries expense for the total gross earnings of that employee, and all employees. The net pay is what cash is coming out the door that day. So when the employer cuts the check to the employee, the asset cash is going to go down. And then all of the deductions that were taken out of the paychecks and withheld by the employer are going to become liabilities because they will be paid in the future. So the company will book a liability for each one of those deductions, state federal income tax, the FICA, and any other things. In this case, it was a state disability insurance. But all of those amounts that were deducted will become liabilities for the company to pay in the future. The amount of deductions from the employee's paycheck is not the only payroll liability that the employers will book. Employers will also have to pay a matching amount of the FICA taxes. So all that Social Security and Medicare that's going to the government, the employer will pay the exact same amount the employee is having to pay. And this is what we call a matching contribution. So if the employee has $100 withheld from their paycheck for FICA, then the employer must reach into their own pocket and pay that same amount of money. So whatever the employee is paying for FICA, The employer is going to pay the exact same amount. And then the employer is going to pay this, what we call SUTA and FUTA. These are the state unemployment and federal unemployment taxes, and they're based on the wages of the employee. So if you ever hear that the unemployment tax is increasing, you don't really need to worry about it impacting your paycheck directly, because that tax doesn't come straight out of your paycheck, and so the employer must cover that tax. So state unemployment and federal unemployment are paid by the employer, not the employee. And the employer will book an expense for the amount of tax they owe for FICA and any of the unemployment taxes. So here we see the expense for the amount of the FICA and the unemployment tax that they will pay in the future. So don't worry about where these numbers come from. They're just arbitrary. But notice that the liabilities are increasing by the amount the stockholders' equity goes down. So we're still in balance with our accounting equation. And then when the employer finally cuts a check for all the taxes to the respective collectors, they'll credit cash for the employees' payroll taxes that were deducted, and then all of the other taxes the employer is responsible for. So they can reduce their payables for the income tax that they're paying for their employee, the FICA payable, so that's 2 times the amount that was calculated, right? Because there was the employer's portion and the employee's portion, and then all the other things they might have deducted from their employee, like in this case United Way. And then the unemployment taxes the employer has to pay. So all of those payables they had set up for the amounts owed, they're going to pay. Not only the company's or the employer's payroll taxes, but also all that money they deducted from the employee's payroll, they'll go ahead and pay that to those responsible parties. So let's move on to notes payable. Notes payable represents the amount the company owes to others as a result of issuing promissory notes. So 4 key events occur with any note payable. We have the establishment of the note. We're going to accrue the interest incurred but not paid. We're going to record interest paid and record principal paid. And 3 and 4 usually happen at the same time, but for simplicity, let's separate them. Okay, so assume here that on November 1st, 2015, General Mills borrowed $100,000 cash, a 1-year note that required them to pay 6% interest and 100% principal, both on October 31st, 2016, so 1 year after the date of issuance. So this should be pretty familiar. We're going to take our cash, which is an asset, and increase it by $100,000, and then our notes payable will increase by $100,000 because we need to pay back that principal to whoever we borrowed the money from. And of course, cash will increase, so it's a debit, and notes payable will increase, and it's a credit. Okay, the second key event in accounting for notes payable is to accrue interest that's been incurred but not yet paid. So we want to recognize the right amount of interest expense at the end of our year so our financial statements accurately depict expenses. So remember here, we book revenue and expense when earned, not when paid. Okay, so let's calculate the accrued interest for just 2 months from November 1st, 2015 through December 31st. So if we had a principal of $100,000 and our interest rate is 6%, remember interest rates are always annual, but we want to account for only 2 months at this time, okay? We want to account for 2 months till the end of the year. So the product of all that is $1,000. We want to show that we'll pay that $1,000 in the future, and we want to show that there is an actual expense to us at the end of the year, okay? So we want our financial statements at the end of the year to show we have incurred an expense. Expense will be debited and our pay will be credited. We want to increase both of those. The third key event in accounting for our notes payable is to pay the interest when due. So as shown on this timeline, the $6,000 interest payment, so that's the full amount of interest, $100,000 principal times 6% times the full year is $6,000. That includes the $1,000 that we already accrued for the year ending 2015, and then $5,000 for the 10 months during 2016. When analyzing this transaction, we're going to find that the asset for cash is going to be decreased by $6,000. We are going to pay the full amount of interest owed. So that includes the liability we already set up of it's $1,000. We'll decrease that liability we already set up, and then at that point we can record the expense for the other 10 months we haven't recorded yet. So that would be the $5,000. So we're in check here. Our cash goes down $6,000. Our liability goes down 1,000 for the 1,000 we recorded during 2015. And now we'll record the expense for 2016. Expense is going to be debited and increased. Payable will be debited and decreased, and cash will be decreased also with a credit. And now the final step in accounting for our notes payable is to actually pay the principal back. So pretty simple. Our cash will come out. It'll be decreased by $100,000. Our payable, we will reduce that obligation. We don't owe money anymore. So our notes payable will drop. It'll be a debit. Cash will drop. It'll be a credit. Okay, just some more notes on other common current liabilities. Retail companies are required to charge a sales tax in most states. Some states actually don't, but here in Kentucky we do. Retailers collect sales tax from consumers at the time of sale and forward it to the state government. Just like the payroll tax, the tax collected by the company is reported as a liability until it is forwarded to the government. Okay, and also this should be familiar to you that some companies are actually going to receive cash before they provide goods or services to their customers. So this is common for airlines. Tickets are booked in advance. We call that unearned revenue until that actual flight has incurred, until the actual service has incurred in case of airlines. At that point they can record the revenue, but until they do, it's called unearned revenue, and that's a liability. Let's look at sales tax. So Best Buy sells a television for $1,000 plus 5% sales tax. So the sales tax that is collected by Best Buy is actually just $50. So Best Buy will collect from their customer $1,050, but part of that's not theirs. Part of that money, the $50, they are going to have to owe somebody. They're going to owe the state government. So they'll make that a payable. They'll pay the government at some point in time. But they can record the revenue off of the sale of their television for $1,000. Cash goes up, $1,050. Our payable increases and our revenue increases. We'll credit those two amounts. We looked at a handful of current liabilities, so let's now focus on our long-term liabilities, which are those obligations that are not payable within the company's current year. Some common long-term liabilities include long-term notes payable, deferred income taxes, and bonds payable. So occasionally governments and very large companies need to borrow more money than a single bank or a single lender would want to provide to them. And because issuing a promissory note for such a large amount, let's say maybe $1 billion or $100 billion, issuing a promissory note for that amount is kind of impractical. So companies instead issue bonds, and they can issue bonds to a lot of people at once. And bonds are financial instruments that outline future payments as a company promises to make exchange for receiving a sum of money now. So from the company's perspective, the bond is a long-term liability. They could last for years, if not decades. Three key elements of a bond are the maturity date, the amount payable on the maturity date, the stated interest rate. The face value of most bonds is usually about $1,000. Now the stated interest rate is always expressed as an annual rate. And some bonds actually require interest payments every 6 months. Let's keep bonds very basic. There's many different kinds. You can sell bonds for above the face value or below the face value. In general, though, when you issue a bond, you'll receive cash and you'll book a liability because you will need to pay that money back at some time. Let's look at some common ratios used to evaluate liabilities within a company. The first one we'll look at is the debt to assets ratio, and then we'll look at the times interest earned ratio. Okay, the debt to assets ratio is pretty simple. We're going to take our total liabilities over our total assets. So in this example here, we have a debt to assets ratio of 0.643. And what this means is that creditors have provided financing for nearly 2/3 of the company's assets. And of course, you always want to analyze these ratios in terms of other companies within the same industry. And the last one is the times interest earned ratio. One way to judge a company's ability to pay interest off of those long-term or short-term debts is to ask whether it has generated enough income to cover its interest expense. So here we have a ratio of 9.19. So this means that $9.19 of income is generated before the cost of all the financing and taxes, things like that, for each dollar of interest expense.